The Nasdaq OMX Group could face antitrust obstacles in its hostile bid to acquire NYSE Euronext. That news breaking on Friday. For more, we are joined this morning by the president and CEO of Liquidnet, Seth Merrin. Liquidnet is a trading platform used by institutions such as mutual funds to buy and sell large blocks of shares. Seth, great to have you joining us.
Nice to be here.
Before we get more into the consolidation and regulation aspects of this, how is this bid by Nasdaq, if it goes through, going to affect your platform?
Well, the one thing that is not being addressed by any of this consolidation is the institutional sector. So, the exchanges have always been really good handling retail size orders, not so good at handling the growth in the institutionally managed sector, which is where we come in. So, we've partnered with OMX, we've partnered with Nasdaq and New York Stock Exchange, and I would say that we would continue to do so. We serve very different constituents, and by combining our liquidity, we make the whole market more efficient.
But does it benefit or does it hurt your business if they merge?
I think it's net neutral. I think that for the institutional sector, that's not their customer. That's our customer.
But they want it to be their customer.
Well, we believe that they should offer additional services, but historically, when they go after the institution, they have not really addressed their needs. They have not gone for quantity discovery, which is what the institutions really need.
Does this whole kind of exchange merger mania that's happening right now really go to affecting what's happening in a fragmented market? There are so many different venues, so many different exchanges, so many different dark pools or other trading venues, ECNs. What does this mean in terms of the overall picture? Does this really change it at all?
This market has historically been very much of an accordion market. So, we started off with a duopoly, New York and Nasdaq, and then the ECNs came out in the 90s, and then they were consolidated back up, and we were left with the duopoly. And now we're talking about, there are many different execution venues out there, but from an exchange perspective, consolidating the exchanges at this point is not a bad idea.
And it does leave you with a few personalities at the top, as opposed to a bunch of personalities at the top. Everyone trying to decide if there is a U.S. name to be the global representative for the exchanges. Who's a better one, Bob Greifeld or Duncan Niederauer? Who do you think?
Well, both are excellent operators, quite frankly. They just don't get along between them.
So can they get along, do you think? Look, it's unclear as to whether or not Duncan Niederauer would stay if Nasdaq were to win the day, but he is a diplomat. How do you think he'd
Generally in a hostile situation, I think this must be the first hostile deal for a cash equities exchange ever. But generally in hostile deals, one of them, and only one of them, stays. So I would assume that that would remain constant in this deal as well.
Seth, would you raise any anti-competitive objections to the regulators?
From a trading perspective, there's more than enough competition out there. From a listings perspective, they would own the listings business, and I would assume that the regulators would take a very close look at that and perhaps mandate competition. We know that BATS wants to offer listing services. It's a question as to whether the public companies would like to switch their listings and what services BATS can offer. But that would be a monopoly.
Okay, but this consolidation, though, or this, whatever merger it is between either it's the NYSE and Nasdaq or between the Deutsche Börse and the NYSE, does it make it harder, though, for your exchange to grow because they merge their powerhouses together? Does it, does your share of the pie get harder to get?
I don't believe so. What we do is, their customer base are the broker-dealers. Our customer base are the institutional asset managers. Very different customer bases. So again, the exchanges from the very start have always focused on the retail investor, but the institutional asset management or assets under management have grown 40 times in the last 30 years. Massive. And they have not focused on that. We bring 650 of the largest asset managers around the world together, and we allow them to trade in 39 different countries. So we're clearly a global player already.
Now, Seth, when it comes to all these exchanges, all of this fragmentation like we've talked about, these dark pools, a product that you kind of specialize in as well, do you think that we're going to see even more proliferation of those as broker-dealers start to get more involved in the mix and other venues develop? Does that become much more of a trading aspect than does the traditional exchange?
Well, there's so many variables there, one being regulatory. So we still don't know where the SEC is going to come out on all these different dark pools. But what they have said is that, not all dark pools are equal. And what we provide is this massive execution size, and we provide things that cannot be found on the exchange just by virtue of the dynamics of the way the institutions trade versus the way that retail trades. So we provide massive size in terms of execution. We provide massive price discovery. And because we do things that are not found on the exchanges, the SEC, in its proposal, looks like we might have less regulation on us than the other dark pools, which are really no different or very little different from what is found on the lit exchanges.
Okay, so does that mean, though, because reading into that, does that mean regulatory framework is your biggest risk in the growth to your business or growth to this business?
Well, we're taking a look, and we think that the regulation that's going to come out on us is going to be very favorable. They do not want to regulate out things that are competition or things that cannot be found on the exchanges, things that the institutions need to trade. Very different venue from the exchange. The exchange has a lit market. It's a very small bid and ask. The institutions, they need to trade in massive size. They don't want to put all of that supply demand on the exchange. Very different markets. You put them together. We have quantity discovery. The exchanges provide price discovery. Together, we create a better market structure.
Okay. Seth, thank you very much for dropping by.
My pleasure.
Seth Merrin, the president and CEO of Liquidnet.